Okay, folks, welcome to a morning update and member stock chart request. This is where we review. The symbols are members submit for me to review. Members immediately following the review of your request and an update on the U.S. futures markets. We're going to roll right into a strategy session. I did not do a market wrap last night because I was at a dinner of some industry professionals in Manhattan. And I can tell you from my conversations with people, they have no clue about what the impact is on our economy, on our way of life, that the economic data that was released yesterday validated. We already knew this for weeks now, months now, that we were seeing a sea change. We called the recent top in the market. We called the bottom in gold. We didn't make those calls because we didn't have an opinion of how our fiscal and monetary policy was going to impact the overall economy longer term. And yesterday, we were validated. I said that inflation would rise. They released the CPI data, that's the Consumer Price Index, and they revised the prior period higher. And this period, they expected a 0.2 read. It came out 0.5. The Atlanta Federal Reserve, which only 2 weeks ago came out with a 5.4% read, an estimate of Q1 GDP, ratcheted down to I think it's a 3.1 read for Q1, and they're not done yet. We still have another month and a half to go in this quarter. Retail sales. A lot was made of the prior month's retail sales numbers, which were really good. They were good retail sales numbers. Guess what? They ratcheted them down to flat, and they missed last month. So you have prices going up, consumers spending less, exactly what they're supposed to be doing. And when the time comes that the federal government gets the bill and they have to come to the taxpayer to raise taxes, the problem is there's no money to be had. And all the conversation about people getting pay increase, that's going to get eaten away in a heartbeat by inflation. So in short, this economy is on a collision course with stagflation. Remember that word, stagflation. I talked about it in my 2018, the year ahead forecast. I said that inflation was going to come to the forefront. Here we are. They delivered it to us on a platter. And guess what? There's more coming. Why did the markets rally yesterday if I'm so right about my comments? It's because Powell came out the day before and for all intents and purposes put the Powell put under the market. But I think the market is misreading how aggressive this guy is going to be. He is not going to indicate, and he hasn't indicated, that he's going to stop rolling debt off the balance sheet anytime soon. They've said that that's on automatic pilot. So they don't even need to raise rates to keep interest rates moving higher. And for those of you that are not familiar with what I'm talking about, rolling off debt off the balance sheet, well, they put a nice fancy name on QE1, QE2, QE3. That was quantitative easing. They printed money. And all was good. Everybody was happy. They were on a euphoric high. That all ended in, I believe, 2013. And in 2015, Q4, they raised interest rates for the first time in 9 years. So what they're doing now is the opposite of QE. Remember, QE made the stock market go up dramatically. So if QE, 3 rounds of it, they needed 3 rounds because the first 2 didn't work. They think the third one worked, but they're going to soon find out because they need to go back to it in the future that, of course, it didn't work. But they'll claim victory nonetheless. So if quantitative easing was good, how is quantitative tightening not bad for the stock market? And the environment that we're going into right now, let's go to a chart of gold, of which we have a very sizable position in the gold mining names. And you may be thinking that I got my head handed to me yesterday. I did not. We had an outstanding day, probably the best day of 2018, and I'm not even long of that many stocks. Certainly not the S&P 500. So yesterday, here's where the news was announced that Retail sales were poor, and the consumer price index was hot. So we got a read on inflation and weakness in the economy. That is the very definition of stagflation. What did traders do? They sold gold, which is the historic hedge against stagflation. There's no better environment for gold than in a stagflationary environment. But what these nincompoops did, they sold gold and they bought the US dollar. Take a look at the US dollar. Look, they rallied it. They have no idea of what they are doing right now. Members, we'll be talking more about the dollar in a moment, but I'm telling you right now, folks, traders are trading the last bull market. They're going to play the same old leadership, and they're missing the new bull market. And we have been at the forefront of it, and it's just beginning. Get on the train, because at some point in time, they're going to realize that Powell's not going to be starting the printing presses until we see max pain in this market. I do not envy this guy's position, because he has to walk a very, very fine line, probably more finer than Janet Yellen could have ever imagined, because now it's official. He's in a stagflationary environment. She got out of Dodge right before it hit. So everybody better be ready for World War III in the coming months. There's a lot of money to be made. You need to be on the right side of it. Now, let's take a look at the indexes. The members, we're going to go into a strategy session. We're on the dollar. Let's stay with the dollar. The dollar has broken down to multi-year lows, especially against the Japanese yen. And if you think about it, the Japanese yen, they're still printing money over there, yet the dollar can't gain against it. That just goes to show you how flawed our currency is right now. And if we take out 88.438, it's all over. We're going a lot lower. We're going a lot lower. We are going down to multi-year lows in the US dollar. You had better be on the commodity train, because most of these pontificators out there on the financial news media, they have never traded in this environment before. It's an unknown territory for them. And you may be saying, Bob, you're not that old yourself. You weren't trading back in the 1970s. Fair point. But I'm a student of history, and I have been bullish on the gold stocks and commodities for 2 years now, and we were long of gold when it ripped out of the gates in early 2016 into the summer of 16 and made a killing. Now we've been in the consolidation, and we are breaking out. Speaking of gold, we are breaking out. These are all 4-hour charts. We are breaking out. A huge day yesterday. We were up as high as, I believe, $25 per share. We pulled back slightly at the close. It's expected. We were leaning into the third standard deviation Bollinger Band. Smart money was rotating into precious metals, silver, base metals, steel, oil. Now, you may be saying, wow, should I go buy gold now? You're going to get your opportunity, but right now you're buying it at a level where you have a lot more risk. We've been trading in and out of it, and last week we were buying aggressively at the lows of the week. And I'm showing you a chart of the gold futures. We were buying the gold miners, to clarify. So no, you can't go stepping in this morning and buying more. You need to wait for a setup and then a breakout. You need to watch your risk reward. We will be adding to our positions, so come on board. Now the bond futures, folks, this is a disaster in the making. At current, we are at, members on strategy session, I'm going to show you this chart. We are at the precipice of a major breakdown on a monthly chart on the 30-year bond. And you can see from this chart here, we are at the doorstep of a major break in the bond market. What does that mean? How does that impact your life? Well, if you have a teaser rate and you've been floating them back and forth, your balances as the teaser rate expires on your credit cards, that's all gone now, because interest rates are going higher. The 0% days, in all probability, are over. So the best investment you can make right now, pay off your debt. Pay off that, anything that's a floating rate, get rid of it. Pay it off. The Dow futures up triple digits. And while I'm speaking bearishly about the market, they appear to want to press higher. But whenever we see in an environment like this, Dow futures up triple digits, I always warn, Beware the bright green futures. What they are trying to do is they're trying to lure you back into the market. There has been a significant amount of technical damage in this market. We have not based, we have not consolidated. Traders are expecting a V-shaped recovery. I think they're going to be sadly disappointed, and I could be wrong. But the last thing I will be doing is chasing the futures market into a new trading day. That's not going to happen. Let's check the S&P futures. They're pressing higher as well, about 0.75 percentage point. So big moves here this morning in the pre-market. Let's get to member stock chart request. Murphy Oil, weekly chart. I like this chart. We pulled back considerably off of the highs, a high 35.16. We couldn't break out above resistance, but we pulled back to support. So I think that we're very close to being able to pull the trigger on Murphy Oil. The weekly chart looks good. And when I take a look at the daily chart, we have rounding bottoms and the double bottom set up on Stokes and RSI. Good stuff. Price, we had an outside day, meaning we engulfed the prior day's move to the upside. That's a very bullish event. Would I buy these shares this morning? No. Why? I need to see a close above this resistance level here because it's exactly where we were stopped dead yesterday and 2 trading days ago. Volume was good. So the chart is looking good for Murphy Oil. If you trade it, I would use a stop. If you want to keep it tight, right below 26.60. If you want to keep it loose, a stop right below 25.56, both on a closing basis. Give it some room to fluctuate. The next chart up is Shopify. A simply outstanding chart. I always say I have smart members, and they are very smart. Outstanding chart here. Love it. We are seeing a major breakout on Shopify. New all-time highs, which is significant. Why is it significant? It's because we have no overhead supply above. No sellers waiting to get made whole. That is exactly the type of environment that you would think to get overly long in and even trade options to the long side because you have nothing but clear blue skies above. A beautiful chart here. All the indicators are validating yesterday's breakout. Daily chart. A huge move yesterday. We're leaning into the third standard deviation Bollinger Band. We may get a slight pullback. I think that these shares can be bought. Volume outstanding. So Shopify looking really good. You can see that we broke out back here on the 26th. It failed to hold. We pulled back to the lower band of support. This is what I always teach members. Whenever you get a bull trap or a breakout point failure, expect a pullback to the prior low. And many times it will break and break down to lower lows. In this case here, we respected that lower band of support. We reversed. It was a buying opportunity. And here we are today. We broke out yet again on the 12th. We pulled back, retested the breakout point not once but twice. Good stuff. Off to the races. The next chart up is Boot Barn Holdings weekly chart. I love this chart. I love the setup here because you have a massive W formation. We have a W formation within a W formation here on the left side of this W formation and another one here with a more defined higher low setup, and we broke out of a bull flag setup back in November, and here we are today. A beautiful run. We have broken out above the pivot point at 17.26. We've been consolidating for several weeks, backing and filling, and I think that we are breaking out. I think that we are at a good risk to reward entry point to open up a position here and use a stop right below this lower band of support. Keep your loss small and let your profits run. Daily chart. On a daily basis, I would buy strength here. Would I buy this morning? Probably not. We're in the middle of a trading range. The weekly chart looks great. The daily chart, not as great. We're getting more granular here. I would prefer to see a rally and a close above resistance. And then I would think to pull the trigger. RSI is holding support. Stokes doing the same thing and beginning to hook up, but no breakouts yet. So I would be patient here. I wouldn't go jumping in this morning and buying these shares, but soon, and I may be a part of it as well. So a really good call here on all three of these stocks. Now, members, let's segue into our strategy session for this morning. Okay, members, we're going to kick things off with the chart of the 30-year bond. We've talked about this chart for weeks now. We spoke about it as it broke down below the lower band of this triangle formation. We spoke about it when it broke down below this lower band of support here. Look at where we are now. We are retesting the long-term lower band of the rising uptrend channel. And guess what? We are now trading slightly below that level. Why does this matter?